But again, guys, remember, before you place any trade, you have to fully understand all possible outcomes of it, and you invest your own money, and you have to make your own decision, and don't rely on anyone's opinion, even if it is mine. Okay, guys, it is very, very important to understand. Now, let's have a look at option strategies. I understand that for some people, it might be completely new. You don't know how to work, but still have a look. So first, we're going to look at short trades, selling puts and selling covered calls. And at the moment, the price 245, it tells me, okay. And these are options which we can receive. If we sell a call until this Friday, we can get how much? 2.5. Like the spread is huge. This last trade was $3.5. So $3.4 on a $245 like capital allocation. What's the percentage of return? 1.4, right? 1.4 until this Friday. So it's actually 4 days, right? Only. Is it good? You have to decide, right? So if we go for next week, December 24th, okay, Christmas Day, we can get $5. Okay, that would be 2% for 2 weeks. Now, how much money you guys are getting in the bank? Okay, and if we go for 245 for December 31st, it's $10. So it's actually what, 4%. Okay, so do you want to do that? It's up to you. Okay, so but you can get 4% within 3 weeks by selling puts. And even if you buy the shares at 245 by selling this put, your average price would be $235. Okay, this is simple as that. Now, if we're going to look for leaps, I took the duration July and January 2022 and January 2023. Okay, so okay, the question is, premiums are pretty good, yeah. So you might change your mind, Mick, right, about your company or not your company. Let's have a look. If we buy calls, okay, buy puts. So usually just when I trade already, I decide which strike price I choose. Usually I look at out the money strike price, but for the valuation of the option price, I just compare how much we're paying for that. And the price for this specific company, so ask price, $38. This is until July. Okay, so if we buy, we have to pay $38. In percentage terms, guys, who can calculate quickly? How much is that? Close to 15%, right? Maybe even, yeah, maybe even more than 15%. Someone calculate too much, right? So it's just less than a year. If we go for January, so it's one exactly year, 245 again, $45 we have to pay. So it's quite a lot. Practically 90% we have to pay for this specific company. So if we decided to trade this particular share, is it better to buy call options here, or is it better to sell put options here? Remember, when we're buying something, we pay for this time, right? When we're selling, we're collecting it. So in this particular company, I presume it's kind of obvious. It's much better to sell puts and make money by rolling those puts in the future. Okay. And by the way, they have, look at this, they have spreads on that type of price. They have $5 spread, which is not bad. Okay. And they have weekly options. The only thing which I don't like at the moment is the spread between bid and ask, quite significant, okay, which kind of not good for me. Okay, that's why I would personally do just buy share and sell it again. So just do this kind of with short-term trading and make exactly the same money as on selling puts. But we'll see. Actually, I think I have an order to sell put myself, even I am telling that I prefer to buy and sell, but I think I placed last night the sell put. It wasn't triggered. I checked it this morning, so I have to adjust it. But again, yeah, so Olga, just to the point, in order to sell put, you have to have $24,000, because if you buy one contract, it's you have to be able to buy 100 shares of it, which will cost you 24,000. Okay, so some people can manage this amount of money or portfolio on your account. If you don't, so definitely don't go there. Don't risk. Don't allocate all your money in one particular share, especially volatile as Biogen. It's much better just to buy maybe 10 shares. Buy 10 shares, pay $2,400, right, and then to sell them high. So maybe it is.